The reason why most agents fail, make less than $50,000 a year, or can't go full time is because of these two formulas that we see here below. Formula number one, you have the life insurance agent. They only sell term life insurance. That's all they know. That's all they've been educated on. That's all they understand. They run a term life insurance policy on the client. The client gets declined. Agent makes no money. And then you have formula number two is that the agent only sells final expense. The client wants term. The agent's like, I don't have access to term. I don't know how to sell term. I don't know how to talk about term. So the agent walks away with no money. You see the two formulas here? The two formulas has the agent blocked into a corner with only one product being offered, either because of the IMO that they're associated with, who only does that based off of culture, or because the agent never educated themselves on additional products to understand the client's needs. And because of that, the agent makes no money. And by the way, you earn money on commission from servicing clients. So if you don't understand how to pivot, which we'll talk about in the next part of this video, that's the formula on why no money is actually earned. So let's talk about the actual winning formula. The winning formula that I've trained all of my agents on is you have the life insurance agent. They understand all of the insurance products, term, whole, IUL, final expense, children's whole life, annuity, and then they educate and service the client based on their needs, right? They're servicing the client based on their needs, not on the agent's needs. And then if the client is declined, then the agent pivots to another product because the agent understands all the insurance products to ensure that the actual client walks away with some type of life insurance coverage. That's the winning formula to ensure that as an agent, you are always servicing clients, you're always protecting families. No one gets off of the line without life insurance coverage, and you're ultimately earning commission every day from doing this full time. And imagine being full time where you can actually help people every single day of your life. You need a winning formula in order to do that. And today in this video, I'm going to be walking you through all of the different products from term, whole, IUL, final expense, children's whole life, and annuity so that you can have a good understanding, so you can go out there and get the contracts that you need so that you can service clients holistically, so that every person that you talk to can walk away with coverage. Let's jump right into it. Let's start off with term life insurance, right? Like, I think this is the easiest type of coverage that's out there to understand. But what is term life insurance? I'm going to give you an example. Let's say that somebody, you have a client. A client has a 30-year mortgage for $300,000. So that type of client, in many cases, with that $300,000 debt that they have on that mortgage, they should get a term life insurance policy. Why? Because if they pass away and that $300,000 mortgage is still there, then now that debt passes on to the spouse, and the spouse may not be able to afford to pay that on one income. Family loses their home. Pretty simple concept there. That's just one case study of why term life insurance is needed. And you have your 10, your 20, and 30-year term life policies. You may even find 35 and 40-year term policies out there, depending upon the carrier that you get contracted with. And what happens is that at the end of the term period, the term policy expires, or it can renew based off of the new age. So let's say, as an example, I'm 30 years old, I get a term life policy, and it expires at the age of 60 years old, 30 years out. Then now, if I want to get that term policy again without having to go through the health records, then I'm going to have to renew based off of my age on what term will cost at 60. Okay. Now, the benefits are this is the most affordable coverage that's out there. And I think most people who are on a budget, term is the right type of policy, right? For most who are on a budget. And the trade off is it expires. Um, so if the person doesn't pass away within that 30-year period, the death benefit is not paid out. The client was just paying into this policy, no benefit. Just like car insurance, you don't get into a car accident, you know, you've been paying money to this car insurance policy. Cool. And then it renews at a higher price. So those are the trade-offs. But at the end of the day, term life insurance works. I think every life insurance agent should have this under their belt. Next, you have your whole life insurance. Now, whole life insurance, this is where a client may have a goal where they want coverage until death. So I've been on the line with clients who are like, Don, I don't want term. Nope, don't want it. Nope, I'm okay. And I'm like, but, and they're like, no, 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 no. I don't want term life insurance. I want coverage until death. No matter how much you try to educate them, some clients have educated themselves and they've already made a decision. With that being said, this is where if a client wants coverage until death, then that's where whole life policies come into play, where these policies don't expire. You've probably heard it either whole life or permanent life insurance coverage, okay? Now, these policies may also earn some cash value, where basically what does cash value means? It means that a percentage of the premium, the payment that goes, the percentage of the payment that the client is making every single month, a percentage of that goes into what I like to call a savings account. I like to use that analogy as kind of like a savings account, with a small percentage that goes there where the client can use it while they are alive for, as an example, emergencies. They call the insurance company. They can pull up, they could pull money from, withdraw money from their, kind of like a savings account. Now the benefit is it's permanent coverage, meaning that it stays with the client until they pass away. And generally speaking, the price point doesn't change over the life of the policy. So if I got a whole life policy at the age of 30, I'll be paying the same price at 40, 50, 60, 70, 80, 90, generally speaking, and it earns some cash value. The trade-off is that it's more expensive than term life insurance coverage, and yeah, it's more expensive than term. That's really like the biggest trade-off there, where everybody can't afford whole life coverage, and that's the tough part of it, is that if somebody's on a budget, whole life won't be for them because the policy will ultimately end up canceling because they'll run into a hard time, they can't afford to pay it, and they'll lose their coverage. But at the end of the day, whole life works, of course, when clients have goals of where they want coverage until death, or a client is at a certain age in their life where term life insurance is extremely expensive. So it just makes more sense depending on how old they are, where a whole life just fits into the equation. Let's say you have somebody that's like 48, 50 years old, and like whole term life insurance starting to get up there. Whole life is like, it's better to have like less death benefit, but keeping that policy for life versus a term policy that expires for them in 20 years, but they're 50 and in 20 years they'll be 70. So, things like that you need to understand when it comes to whole life, but that's not the video here today to be able to break that down. Next, you have your FEX policy, which is your final expense. Now, final expense policies, these are more so geared towards people who are an older age. Normally, like I would say 60, 65 plus, 65 plus, 65 to like 90 years old. Now, these are, like I said, clients who are old age, 65 plus, they don't have any coverage. Maybe their policies ended up expiring, or they just waited until the last minute and now they're here and they're like, I need life insurance because basically I'm going to pass away and I don't want to be able to leave this, these bills, this debt, this funeral expense to my children. And I don't think that is cool. So they're like, I need some type of final expense policy. Generally, the clients already know what it is, and they're like, I know I'm going to pass away. I just need something, right? It's a easy, simple, transactional conversation, and they're really not doing it for you. They're doing it for themselves because they know. Now the policy doesn't expire. Now you have normally two types of final expense policies. You might have your standard final expense, where this is just a policy for somebody of older age. The underwriting guidelines and the application are generally shorter for final expense. As long as the client doesn't answer like no to certain questions, then the final expense policies normally get approved. Now, then you have your guaranteed final expense policies. Now, these type of policies, depending on the carrier that you work with, it may start at like a certain age. Some guaranteed final expense might start at 35, some might start at 45. It all depends on the carrier. This is for people who have serious health issues, where like let's say that a client has like a chronic illness or terminal something of that nature. Now, what happens with guaranteed policies is that there's a 2-year waiting period. So essentially, what that means is that let's assume that a client gets a guaranteed policy because they can't get any other coverage. Like this is like your last resort type of policy, guaranteed, and this is the only policy that they can get. And let's say they're paying $150 a month for this policy. What happens is that every year they're paying $1,800. So over the course of 2 years, they're paying $3,600. If for whatever reason they pass away within that 2-year period because they have serious health issues, which the insurance company already knew this, then what will happen is that depending on the policy and the carrier, the carrier will pay back. They'll pay all the premiums that the client paid up until that 2 years. They'll pay it back to the beneficiary. They'll just pay back the premiums. They won't pay out the death benefit. They'll only pay out the premiums if the person passes away within that 2-year period of time. Then if the client lives beyond that 2 years, then they'll pay out the actual death benefit upon passing. So that's like one of the caveats of a guaranteed policy is that there's a 2-year period. If the person passes away, they're going to pay all the premiums back. Basically, a refund of premiums back to the beneficiary. So the benefit is older people can get coverage. And then at-risk people can get coverage, which is like your last form. The trade-off is the death benefit is lower, and also there is a 2-year waiting period. But at the end of the day, final expense policies also work. Then you have your loading here. You have your IUL. This is kind of more of like we're getting into like more advanced market stuff. And this is something like if you don't know IULs, you should know. You may not be dealing in advanced market, but you should still understand it. I learned advanced market because I worked in banking. So all that we sold at the banks were IULs and annuities. And I had to read every page of every contract. So I got really good at understanding how to talk to people who had money and they were looking to park that money and do different all types of crazy strategies, etc. So an IUL is an index universal life insurance policy. Now this is generally for people who want life insurance coverage. They want to grow their money, but they want life insurance coverage and they want to grow their money, like the money that they're paying into the policy. If they're paying a certain amount, they want that money to still be earning something if they're paying it into the insurance policy. And then they want to still grow, but they don't want much risk, right? Very, very risk averse. They're like, I don't want a lot of risk here. I don't want it to be tied to anything crazy where I'm going to lose my money, etc. And they may have this could also be for clients who may have maxed out other vehicles. So generally, you might get clients like when I worked in banking. The reason why they're moving to an IUL is because like they may have maxed out their IRAs. They may have put a certain amount of money into the stock market that like they're like, I don't want to put any more this year. They maxed out like their health savings. Like they maxed out all the vehicles that they could. So now an IUL becomes a good alternative for them to be able to continue to fund more money into other vehicles that allow for more growth, but without a lot of risk. And it comes with the benefit of life insurance coverage, right? So that's where your IUL comes into play. And these are generally, like I said, for clients who have a certain amount of money that they earn on an annual basis, where they can afford to be able to kind of do something, a strategy like this. And there's reasons for that. Now, with an IUL, this is a form of whole life coverage as well, meaning that somebody can keep an IUL until they pass away. It's a form of whole life, just a different form of it. Now, what happens is that just like with whole life, people are putting more money into IULs though. Like let's say somebody's putting 300, 400, 500, 600 per month. I'm not going to go into the full details, but essentially if the policy is structured the right way, what happens is that the client is going to start building up a bunch of cash value inside of their policy. That cash value is now tied to the performance of an index. Let's say that index is the S&P 500. Okay, which is basically the 500 highest performing companies in the United States of America, and it's tied to the performance of that index. And depending on the insurance carrier, they'll credit up to 9% interest per year to the client's cash value. Okay, so that's simple terms. There's a lot more that can go into detail on IUL. So when you want to make sure you do your research and understand what's going on. Now, the benefit of an IUL is that there's high cash accumulation that can occur in an IUL from clients paying money into it, and then the benefit is also a death benefit. And lastly, clients can loan on the cash value gains, which basically means that let's say a client has paid $100,000 into an IUL over time, and from that 100,000 that they paid in, let's say that they've also received like 20,000 in gains. What I mean by gains is that from the interest that's earned over time, there's $20,000 of gains there. Like that's how much that they've accumulated, like on their money, instead of them withdrawing the $20,000, where now they would end up having to pay taxes on the $20,000, they're going to take a loan against the gains, which is a very common strategy in the stock market as well, where people will, let's say that they have 40,000 in unrealized, the word of it is called unrealized gains from a tax standpoint, right? You're not taxed on unrealized gains. You're only taxed when it's realized, meaning that you actually withdrew the money from the stock market or you withdrew the money from the IUL. So a common strategy is to take a loan against the gain so that it remains unrealized and you can still utilize the money anyway. So let's say that if the loan was 4%, on you like taking out that loan, the idea is that I can do more with the money in my hand than the 4% that I'm going to end up paying on the actual loan of the gains. That's the goal. Now, so when people use the concept, oh, you're loaning against your own money, these individuals are just simply ignorant to understanding how finance works. Because in every market, people take loans. For instance, in the real estate market, instead of me selling my property, and let's say I bought the property at 400,000, the property's worth $1 million. I have a $600,000 unrealized gain that when I sell the property, I can now access the 600,000 in profit. But instead of me selling the property, I go to the bank and I get a home equity line of credit for 600,000 or up to 80%. I'm not going to get into the details, but I could take a loan against that and I could use that money to be able to buy more property, but the bank is only charging me 6%. You see, it's okay for me to pay the 6% if I'm earning 15, 16, 18, 20% on that same money, right? So again, when you hear this concept of, oh, you're loaning against your own money, these individuals are simply ignorant. And again, that goes back to the original point that they don't understand how all of the different products work in life insurance. They've only been taught based off of whatever company that they're associated with, and they've been sold some type of story or fairy tale on how finance actually works, and that's just simply not how it works. So that's the benefits, and then the trade-offs is if the IUL is not structured the right way, the cost of insurance can be high, and I'm sure you might have heard this before, where if the cost of insurance is high because not properly structured, again, which I'm not going to get into details on because that's a very long conversation on how to properly structure an IUL. There's a bunch of videos out there on how to properly structure an IUL. With that said, if the cost of insurance is too high, then over time, as the client ages, if they're not putting enough into the IUL, if they're not putting enough into the IUL versus the cost of insurance, then it can start eating away at the cash value until it goes to zero, and then the policy ends up lapsing. But you should watch videos on that because there's a lot of people out there who are very, very smart at IULs and how to structure them the right way. But reality is IULs work depending on the client, just like everything else. And last but not least, you have your, I didn't change the wording for it, but you have your annuity. Now, with an annuity, this is for a client who has a lot of liquid cash and they want to park it into a safe place. This is something that was very big when I worked in banking, where like you would have clients who'd have like $150,000 sitting in their savings account. Like, like you believe it or not, there are a lot of people who like I got 100 grand, 200 grand, 300, 4.5 million. It's just sitting in a savings account at 0.01% interest. Like they're like not even thinking about it. Like they're not doing anything with the money. They have no intent for the money. Like they already have money in the stock market. They own their house. They got real estate. They got all this stuff, and they just got the money parked. Like they don't care to do anything with it. They don't want to put their thought process to what to do with the money, right? So what would end up happening at the bank is that we would call these clients and go, hey, like you got a 500,000 sitting in the bank at 0.01% interest. Like, have you ever thought about other options that are out there to be able to help you? Like, not anything that's going to be extremely risky because obviously you have your money sitting in a savings account, so it's for an emergency purpose. Like, what if we just showed you an alternative so that you can at least beat inflation, right? Like, if inflation's 5% and you're not earning up to inflation, you're losing purchasing power. I'm not going to get into the whole process of that, but that's where an annuity may come into play. Where an annuity is a life insurance contract, it's not necessarily a life insurance policy. Those are two different things, right? Like, it's a contract. It doesn't necessarily have a death benefit. But a life insurance company annuity is a contract, okay? Now what happens is that, let's say that that same client is like, you know what, Don, okay, cool. I do got a half a million sitting in the bank. Let me just take 250,000 of that and let me dump it into an annuity, and I'm going to park you for like the next 5 years. Like, I'm not going to do anything with the money for 5 years, but at least it earns something. This is where they would, sign a life insurance contract, wire $250,000 to the insurance company. They open up an account, and a fixed percentage of the interest is paid on that principal. So essentially, the insurance company might say, "Hey, we'll pay 6%, 7% a year on that principal over the course of these 5 years. Like that, that's how much we'll credit to the interest. And then at the end of that 5 or 6 year period, the principal plus interest is now paid to the to the client, and it can be paid out in many different forms. It can be paid out as like one form of an annuity that you might have heard of is like the lottery. Like, a person, instead of them getting a large lump sum of check, then they could get paid out like for life. Like, hey, structure all of, like, this is what an annuity is. You can structure all of my payments, my principal plus my interest, structure it to where I'm paid every single month for the rest of my life. You could structure the annuity that way. You could structure where you're just getting a one-time payment. Like, you could do a lot of different things on what the actual payout process looks like once the annuity matures. Now, the benefits to an annuity is that there's safety. Okay, like it's there ain't the annuity is basically peanut butter and jelly. Like, it's not a lot going on there. Um, like, certain clients who get annuities, trust me, you'll meet them and they're like, I'm not doing nothing. Like even if you tell them that the stock market is safe and if you just put your money in the S&P 500, nothing's going to happen. They're like, no, 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 not doing it. Not none of that. These are annuity people, right? Like they don't want any risk, no form of it, no thoughts around it. And insurance companies are, some of the safest companies in the world. I mean, they're the ones who, like, pretty much, back everything that we can think of right now. Insurance companies, very safe alternatives. So it gives a fixed percentage on growth, and then generally speaking, there's no health issues, right? There's more of a suitability requirement where they want to ensure that the client doesn't actually need this money for 5 years. So, like, what's their suitability? What other forms of income do they have coming in? So that if they wire us the money on this $250,000 on this annuity, that, like, they're not asking for the money back 3 months from now because, like, they don't have any money, right? Like, this is generally a suitability, like a financial suitability. Now, the trade-offs are surrender charges, and that's the reason why suitability is important, because if the client, decides to pull money from this annuity, or like cancel the annuity prior to the maturity date, then there's surrender charges each year. The surrender charges decrease, but they could pay a percentage of their principal to surrender that policy, which they'll take a loss, which is, that's why that suitability is important before the contract gets written. So that, I would say, that's the biggest trade-off to an annuity. But at the end of the day, annuities work as well. Now, why do I tell you all of this? Like, based off all of these products. I tell you this because of the fact that the losing formula is being stuck under one product, and you can't fully service a client if they're declined or if they want something else because of either ignorance or just company culture. Whatever that means for you, or it could be both. the winning formula, the winning formula that I've seen, the way that I've coached many life insurance agents, I've coached agents that were in my agency, is that, hey, you need to have a full understanding of every product. Like, that's how I was trained in the bank. That's how I've trained every agent. I'm very big on it. I'm very big on reading the underwriting guidelines. I'm very big on reading every product. I'm very big on make sure you have access to every product that's available so that, like, you can fully service a client. That's the winning formula. So no matter who gets on the line with you, there's like a 90% chance that everybody walks away with some form of life insurance coverage, no matter who's on the line. And I think that when you do it that way, you're going to see your business explode. You're going to service more people. You're going to get more referrals. You're going to have less declines overall, and then just bad experiences where clients are like, yeah, I got declined there. Like, don't go there. Like, at the end of the day, people are people, humans are humans. See, you don't control the qualification process, which means that you don't control your quality, right? And then what I mean by that is going into another topic. I'll make another video on this. Is that like insurance agents go, oh well, like the quality of I'm trying to look for a good quality leads. Like, what does that mean? How can you look for a good quality lead if you don't control the qualification process with the insurance carriers? So there's no, like, for example, let's say at like there's an IUL out there and you're like, I want great quality IUL leads. In theory, that sounds amazing. But here's your problem. Even if you were to get a 6 foot, 180 pound guy who has like 8% body fat, he's the perfect IUL client. He wants to put, you know, I don't know, 20, 30, 40, 50, 60. Like, money's not an issue. He wants to max fund his IUL policy, and you go through the application process and come to find out the guy has a felony. How do you stop that? You can't, because the reality is, even if that he was the perfect client, he has a felony. Now, what if it goes the other way around? You get this same exact client. He meets all of the standards, but when he was younger, he was diagnosed with some sort of illness that now won't allow him to get this IUL. The reality is that there's always going to be nuances as to why somebody can't get something, because you don't control the quality. I mean, you don't control the qualification, so that means that you don't control the quality, which is why the way that I taught how to actually scale an agency is screw this whole quality type of thing. Figure out how to just get on a line with engaged leads that are looking for life insurance coverage. And if you have a understanding of every product, it doesn't matter who you're on a line with. Most of them are always going to walk away with some form of coverage, which means that you can spend any amount of money to acquire leads, because almost every lead results into some form of commission from servicing them. The issue only comes when an agent doesn't know how to pivot because they don't understand the products, their ignorance around the product, and then they're out there searching for years and years and years around quality, 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 when the real issue is that you as the agent may not be quality. But every agent that I've trained that is true quality services almost anyone that they're on the phone with, and that's why they can continue to be a successful full-time agent and not have to deal with the pressures of this perfect client. There are no such thing as perfect people. So when you remove that concept from your mind, I believe you're going to be able to build a much more valuable insurance business when you remove that concept of quality. I'm looking for this specific person, right? Like, even if you were like, I'll give you one more example. Even if you were just looking for, like, I'm just looking for nurses, like all nurses. Okay, in theory, that's great. You're looking for all nurses. But what if you keep running across nurses who like fit the standard? They make the amount of money. They do this, they do that, but she has a health issue. She has a health issue. She might be overweight. She might be like, you can't control it. You can't control it. So with that said, have access to all products so that you can service all types of people, and then you can specialize in something specific and major in something, and that you do want to target in on, but you can still service no matter what. And to me, that's the winning formula of how you can become a full-time agent for years and years and years, and the same winning formula of how you can teach other agents in your downline how to also become full-time agents for years and years and years and years. And everybody's servicing customers, everybody's making money, everybody is happy. I pray this video was valuable. I pray you implement this strategy into your agency right away. And if you want more video content like this, my name is Prince Donnell, and I have a free chat with like over 1,000 agents inside of it, where we drop free content on lead vendors, free content on lead generation, free content on sales, free content on recruiting, like everything that you can think of. It's all there for you in that chat, and it's a beautiful chat that really motivates the public. So hit the link below, and I would love for you to be able to join to get more free game to grow your insurance business. Peace.